most people say, if you don't like it here, get out. That's for spineless people. Spineless bastards who don't want to fight for what they believe in.
What we get wrong about closing the racial wealth gap. Myth 1. Greater educational attainment or more work effort on the part of blacks will close the racial wealth gap. A common sense hypothesis ascribes disparities in wealth mainly to differences in the level of education. A college degree is associated with higher earnings and more stable employment, even in times of economic crisis. Families with college-educated heads appear to accumulate more wealth than families with heads with lower levels of education over a lifetime. Therefore, higher education often has been touted as the great equalizer, as a mechanism to reduce the wealth gap between whites and blacks. According to this logic, we would expect blacks and whites with similar levels of education to display comparable levels of wealth. Figure 1 summarizes our findings when we compare wealth levels for heads of households with the same educational attainment across racial groups. Both for blacks and whites, median household wealth increases as the head of a household obtains higher levels of education. However, it is apparent that for blacks, getting a college degree or a graduate degree is far from sufficient to close the racial wealth gap. At every level of educational attainment, the median wealth among black families is substantially lower than white families. White households with a bachelor's degree or postgraduate education, such as with a PhD, MD, and JD, are more than 3 times as wealthy as black households with the same degree attainment. Moreover, on average, a black household with a college-educated head has less wealth than a white family whose head did not even obtain a high school diploma. It takes a postgraduate education for a black family to have comparable levels of wealth to a white household with some college education or an associate degree. Furthermore, low family wealth can have an adverse effect on the next generation's educational attainment. Family wealth is a predictor of both college attendance and college completion. Black students are more likely to take on student loans and accumulate student loan debt, and they are more likely than white students to drop out of a university because of financial concerns. Ironically, their wealth position could deteriorate because of their intense motivation to pursue higher education. Another commonly held misconception is that black families have a cultural predisposition to undervalue education. Black parents are alleged to invest insufficiently in their children's education. However, the best evidence indicates that black families, controlling for household type and socioeconomic status, tend to be more supportive than white families of their children's education through direct financial support. Black parents who provide some support for their children's higher education have 2/3 of the median net worth of white parents who provide no support for their children's higher education. For given levels of household income, parental educational attainment, and/or parental occupational status, black youth also get more years of schooling and acquire more credentials than white youth whose parents have a similar status. While education does not appear to be the great equalizer, it could be argued, alternatively, that hard work can close the wealth gap. Since blacks face a higher unemployment rate than white at every level of education, the difference in wealth ultimately could be due to the difference in employment status. If that were the case, we would observe similar levels of wealth for blacks and whites with similar employment statuses. but Figure 2 contradicts such an expectation. As one would expect, the median household wealth is higher for employed families than for unemployed families in both races. However, white households with an employed head have more than 10 times higher wealth than similar black households. Furthermore, white households with an unemployed head have a higher net worth than black households with a head who was working full time. In addition, higher levels of household income are not associated with significant reductions in the racial wealth gap. Figure 3 shows how black families have much lower wealth than white families, even when they have comparable earnings. In particular, black households in the lowest 20% of the income distribution essentially have zero net worth, while the poorest white families have, on average, $15,000 to $18,000 in net worth. Even belonging to the highest quintile does not make black families as wealthy as whites. Their median wealth is approximately half of that of white families in the same income quintile. The pattern is evident. Studying hard and working hard clearly is not enough for black families to make up for their marginalized financial position. Myth 2. The racial home ownership gap is the driver of the racial wealth gap. A 2017 New York Times Magazine article by renowned sociologist Matthew Desmond stated what he thought to be obvious and uncontroversial. Differences in home ownership rates remain the prime driver of the nation's racial wealth gap. Desmond is far from alone in perpetuating this misperception. A 2015 report from the think tank Demos claimed eliminating disparities in home ownership rates and returns would substantially reduce the racial wealth gap. While the Institute on Assets and Social Polity at Brandeis University wrote an entire report on how interest deductions for homeowners drive the racial wealth gap. After all, the typical household, regardless of race, holds most of its wealth in home equity. Since black families own homes at substantially lower rates than their white counterparts, the argument has it that if blacks only achieved rates of home ownership similar to whites, the racial wealth gap would be eliminated. The word drive suggests a casual link between home ownership / home equity and intergenerational wealth. However, a major flaw in this reasoning is that, by definition, home ownership / home equity is a component of wealth. Hence, the statement that home ownership drives wealth is equivalent to saying that wealth drives wealth. As discussed below under Myth 5, blacks with positive wealth do tend to have a greater share of their asset portfolio in home ownership than whites. Since a home is the largest, usually non-depreciating major asset held by most American households, regardless of race. Nonetheless, in the aggregate, whites have considerably more resources than blacks, greater home equity, and also higher values in every other type of asset. Furthermore, empirically, the evidence simply does not support the claim that the racial home ownership gap explains the racial wealth gap. Figure 4 shows median household wealth by home ownership rates. For those households who do not own a home, wealth levels are low for both white and black households. However, black non-homeowner households have a mere $120 in net worth, insufficient to feed a family for a week. The data indicates that white households who are not homeowners hold 31 times more wealth than black households that do not. Among households that own a home, white households have nearly $140,000 more in net worth than black households. While the wealth ratio between whites and blacks may narrow somewhat among those who own a home, a six-figure wealth differential remains. Clearly, increased ownership is far from sufficient to close the racial wealth gap. Home ownership and wealth are clearly correlated, but it is a severe misstatement to claim that if blacks owned homes at the same rates as whites, the racial wealth gap would be closed. To be sure, a sizable difference in ownership rates exists, as well as a dramatic difference in home equity across black and white homeowners. Figures from the 2017 US Census indicate that 72.5% of whites own a home, compared with 42% of blacks. Nevertheless, substantial regional variation exists. For instance, in Los Angeles, blacks have slightly higher home ownership rates than Asian Indians. However, using data from the National Asset Scorecard for Communities of Color project, Asian Indian households in Los Angeles have substantially greater levels of wealth than blacks, despite statistically having no greater likelihood of owning a home. While closing the gap in home ownership rates may have some benefits, the story is complicated. Indeed, there are various pathways to wealth and assets in which wealth is stored, and these pathways and assets will vary across contexts, including geographic location. Nonetheless, a major underlying difference in home ownership rates is an initial difference in endowments. Broad-based home ownership in the United States as a means to achieve economic security was brought about through public policy reforms, starting with New Deal legislation. The New Deal created relatively long-term mortgage markets and down payment capital finance. It also reduced down payment requirements for home ownership. This transferred the housing landscape, allowing many working-class households to move from the rental lifestyle to obtaining a piece of the American dream, owning a home. Yet the path to home ownership has been riddled with entrenched racism, as the Federal Housing Administration systematically refused loan applications to black families through the policy of redlining. Richard Rothstein has made the following observation in a recent book on the racialized character of post-World War II social mobility policies. The color of law is concerned with consistent government policy that was employed in the mid-20th century to enforce residential racial segregation. There were many specific government actions that prevented African Americans and whites from living among one another, and I categorize them as unconstitutional. For example, many African American World War II veterans did not apply for government guaranteed mortgages for suburban purchases because they knew the Veterans Administration would reject them on account of their race, so applications were pointless. Those veterans then did not gain wealth from home equity appreciation as did white veterans, and their descendants could not inherit that wealth as did white veterans' descendants. Further, the racialized history of housing policy in the US, including residential segregation, redlining, and discriminatory credit practices, have exacerbated inequality in wealth and home ownership rates and have also contributed to the rate of return on the asset itself. Part of the persistent wealth gap across home ownership status may be explained by the fact that a home is one of the only assets in which the race of the owner affects the rate of return. Further, the idea that home ownership creates wealth simply may put the relationship backward. Rather than home ownership creating wealth, having family wealth in the first place leads to home ownership, particularly high equity home ownership. As we discussed in the introduction, Blacks have minimal initial wealth to invest in homes or pass down to their children to assist with down payments. Research by Gittleman and Wolf suggests that when Black households do obtain some wealth, one of the first assets they purchase, similar to other Americans, is a house. But without sufficient wealth in the first place, households have limited means to invest in home ownership. Wealth, after all, begets more wealth. While achieving parity in home ownership rates of return on housing is certainly a worthwhile goal that might improve economic security, stability, and fairness, it is a widely held myth that improving home ownership rates among Black households will close the racial wealth gap. Today, simply advocating the purchase of a new home will not overcome the existing gap produced by national policies. As illustrated above, even Blacks who own their own home encounter a large racial disparity in home values. If the goal truly is to eliminate the racial wealth gap, policymakers should be concerned with providing, at the very least, an initial, significant financial endowment to Black young adults to invest in an asset like a new home, as well as an aggressive campaign against housing and lending discrimination, which limits the asset appreciation of the housing stock and financial products available to Blacks. Myth 3. Buying and banking Black will close the racial wealth gap. In his famed 1968 speech, "I've Been to the Mountaintop," Martin Luther King Jr. called for a bank-in movement. To assert Black independence, King called on his followers to strengthen Black institutions by taking your money out of the banks downtown and deposit your money in Tri-State Bank, a Black-owned bank. This idea that buying and banking from Black-owned businesses will empower the Black community and close the racial wealth gap has been widely embraced historically by a diverse array of Americans, including Booker T. Washington, Marcus Garvey, Richard Nixon, and recently by the #BankBlack movement. From this perspective, if only Black consumers would invest in their own communities, turning inward for solutions to their economic woes, rather than asking the state for a handout, they would become economically self-sufficient and eventually thrive. After all, the premise works as follows. A group with a low profile of achievement does not have to persuade members of the dominant group to embrace policies to repair the outgroup that may impose costs on the dominant group. Everything ultimately can be solved internally with the right amount of spit and polish, rather than creating an inclusive and just economy that does not greatly disadvantage a group solely based upon their race. Politicians across the aisle embrace the idea of buying and banking Black. In 1968, the same year King called for a bank-in, none other than presidential hopeful Richard Nixon came out endorsing Black capitalism.
They don't want to be a colony in a nation. They want the pride and the self-respect and the dignity that can only come if they have an equal chance to own their own homes, to own their own businesses, to be managers and executives as well as workers, to have a piece of the action in the exciting ventures of private enterprise.
In his speech to the Republican National Convention, Nixon proclaimed, "Instead of government jobs and government housing and government welfare, let government use its tax and credit policies to enlist in this battle against poverty, the greatest engine of progress ever developed in the history of man, American private enterprise." Black capitalism, in Nixon's eyes, was the solution. So while white America received ample government support through public policies to build and maintain wealth, Black Americans were offered a deficient private sector strategy. Black capitalism was a solution that would allow the government to hand over the economic problems of poverty and insufficient wealth in the Black community to the community itself, effectively ridding the government of responsibility. But Black businesses and banks cannot thrive on a separate and unequal playing field. For instance, in the US, Black banks are smaller and less profitable than similar white institutions. This is not because the Black-owned institutions lack a strong business model or viable leaders, but because of the economic situation of the communities where they operate and their own disparate levels of access to startup and developmental finance. For instance, since Black families have minimal liquid wealth, their bank accounts tend to hold money for day-to-day and week-to-week expenses. Small and unstable deposits due to continued economic penalties forced upon Black workers and households makes profitability a significant challenge for these banks. In the end, if Black banks and businesses are a supposed solution to the racial wealth gap, we must address a basic math problem that arises. To close the gap, Black banks and enterprises must earn a much higher rate of return than white businesses. Without this condition being met, the gap only will be perpetuated rather than ended. What is the state of Black businesses in the United States today? A recent report by the Association for Enterprise Opportunity indicates that 2.58 million U.S. Black-owned businesses only generate $150 billion in revenue. Unfortunately, this represents negligible ownership and control over the nation's productive capacity. For instance, in 2016, the top 100 Black-owned firms identified by Black Enterprise collectively grossed $24 billion and employed 73,940 workers. In contrast, Walmart, the top firm by revenue in the U.S., grossed more than 20 times as much in revenue and employed 2.2 million more workers than the entire top 100 Black-owned firms combined in the same year. In fact, Walmart, the largest private employer in the U.S., generates more revenue than all 2.58 million Black-owned businesses combined. Black-owned banks are also minuscule in the context of the general scale of American banking. The largest 5 Black-owned banks recently were estimated to have assets totaling $2.3 billion, while JP Morgan alone had an estimated $2 trillion in assets. Thus, the top 5 Black banks' assets were a tiny 0.1% of Morgan's assets. This indicates that the existing infrastructure of Black-owned banks lacks the capacity to produce wide and substantial increases in Black wealth. Even if they were to double, triple, or quadruple their assets, Black banks would not be major players on the American economic landscape, never mind the global landscape. Moreover, since Black wealth is so low in the first place, it is a mere fantasy to anticipate that the existing Black consumer base could build a Black-owned equivalent of JP Morgan by banking Black.
In 2005, is it true that JP Morgan released information directly indicating that it directly benefited from slavery? Would the representative from JP Morgan respond?
I do believe that in 2005 we made a report about potential transactions that involved slavery between JP Morgan or its heritage companies back in the 1800s.
In fact, there was an indication, I believe, that you accepted loans against slaves as collateral. True?
I believe that to be true, yes.
Indeed, the illusion that Blacks have the capacity to build a separate major economy is perpetuated by the oft-repeated observation that Black Americans possess $1.2 trillion in buying power that allegedly has been misspent thus far. Jared Ball has advanced the following potent deconstruction of this contemporary cliche. 1. The claim that Black America has roughly $1 trillion in buying power is popularly repeated mythology with no basis in sound economic logic or data. While the myth has a longer history, it is today largely propelled by misreadings and poor, false interpretations of Nielsen surveys and marketing reports. 2. Buying power is a marketing phrase that refers only to the power of consumers to purchase what are strictly available goods and is used as a measurement for corporations to better market their products. Power here has nothing to do with actual economic strength, and there is no collective $1 trillion plus that Black people have and just foolishly spent ignorantly to their economic detriment. 3. The myth of buying power functions as propaganda, working to deny the reality of structural, intentional, and necessary economic inequality required to maintain society as it is, one that benefits an increasingly decreasing number of people. Note, also, even if we accept the estimated $1.2 trillion total of Black buying power as valid, it still is only 60% of the value of JP Morgan's total assets. A strategy for closing the racial wealth gap currently in popular circulation is to have each of the nation's 40 million Black Americans contribute $10 a month, $120 a year, to a fund to support Black-owned banks who, in turn, will finance further development of Black-owned businesses. But the total amount of that fund would only come to $4.8 billion, a tiny speck in America's overall wealth and national income. The key to assisting Black businesses in their development and growth lies in leveling the terrain of racial wealth differences and increasing Black entree to startup and developmental capital in the first place. Prior research has confirmed that individuals with access to family wealth both directly through transfers from immediate family members and indirectly through kin networks have markedly higher rates of entrepreneurship and are more likely to start larger businesses. See Myth 6 below. More than 2 decades ago, Timothy Bates found that individuals with relatively high levels of education and at least $100,000 in net worth were the persons most likely to undertake self-employment. But today, the median Black household's net worth is 1/10 of the threshold figure for successful entry advanced by Bates in 1995. While some may argue that the wealthy tend to make better entrepreneurs, Evans and Jovanovic argue strongly that the data reject this explanation and that the levels of capital required to start businesses systematically exclude non-wealthy individuals regardless of their entrepreneurial talent. Thus, with the denial of Black wealth accumulation and with the continued exclusion of Blacks from business credit markets, Blacks simply do not have access to the necessary resources to build corporations that can be players in a global economy. A Black American corporate monolith cannot be built on $1.2 trillion in spending capacity, never mind $4.8 billion in seed capital. Mirza Baradaran forcefully argues that buying Black, banking Black is a stance that is symptomatic of an attraction to the chimerical dream of Black capitalism. She contends that, again, In the absence of a wide, deep, and independent foundation in wealth among Black Americans, the prospect of a world of giant Black-owned corporations is no more than a fantasy. Baradaran's central conclusion is capitalism, whether Black or white, cannot fix problems created by racialized public policies. We must make it clear that we have no objection to banking Black or buying Black. In the interest of Black solidarity, the idea has great merit. But the failure to bank Black or buy Black does not explain why we have a racial wealth gap of this magnitude, nor will banking Black or buying Black do much to reduce the gap. Myth 4. Black people saving more will close the racial wealth gap. The finding advanced in peer-reviewed articles in economic journals is clear. There is no evidence that Black Americans have a lower savings rate than white Americans once household income is taken into account. For example, Maury Gittleman and Edward Wolf, using data from the panel study on income dynamics, tracked the financial positions of Black and white families and found that once income is controlled, if anything, Black families actually have a slightly higher savings rate than their white counterparts. This mild savings rate advantage is indicative of even greater thriftiness among Blacks, since they typically have more kin obligations to assist low-income relatives, which further reduces the ability to save. If anything, it appears that Blacks generally live more frugal lives than whites. A study conducted by the Institute on Asset and Social Policy using the 2013 Survey of Consumer Finances found that at comparable levels of income, whites spend 1.3 times more than Blacks. Nonetheless, the conventional wisdom has it that Blacks in search of immediate gratification lack self-control and are plagued uniquely by a culture of frivolous consumerism. This belief was magnified by Ronald Reagan's use of the welfare queen trope during his campaign, and recently via internet financial gurus pushing images of Black America spending money on Jordan brand Nike shoes rather than household needs. Yet the empirical evidence indicates that it has not been the case historically, nor is the case today that Blacks are more financially wasteful than whites. In addition to the Gittleman and Wolf study, economists ranging from arch-conservative Milton Friedman to Marjorie Gallinson to Marcus Alexis, a founder of the Caucus of Black Economists, all found that Blacks have a slightly higher savings rate than whites. However, authors in a 2009 Ariel Hewitt study claim there is a white savings advantage with regards to pension accounts. Using a sample of 57 large companies, they maintain that Black employees have lower participation and contribution rates in company-sponsored 401k plans, even after controlling for salary, job tenure, and age. Hamilton and Darity offer a critique and explain that while the Ariel Hewitt study uncovers racial difference in pension account participation and value, there are no racial differences in pension savings rate. Although the study was updated in 2012, the same criticisms apply. First, it is not clear from the Ariel Hewitt study whether or how income, job tenure, and age are controlled. For example, the Ariel Hewitt study compares participation rates across race, not in a continuous way, but at various income categories. The lowest participation rate difference, 92 versus 91%, occurs in the highest income category, those earning above $120,000, while the widest participation rate difference, 6 percentage points, 56 versus 50%, occurs in the lowest income category, those earning below $30,000. Nevertheless, the report states that blacks overall are 7% less likely to participate in a 401k plan after controlling for salary, age, and job tenure. After controlling for incomes, it is inconsistent for the overall racial participation rate differential to be 7%, while the largest percentage point difference within each of their defined income categories is at most 6 percentage points. This would suggest an unlikely scenario that blacks are better positioned in terms of salary within the defined income brackets and or have longer job tenure and or are older on average. Also, the unit of analysis for the Ariel Hewitt study is the individual rather than the family. This is relevant since wealth generally is measured at the family or household level, and savings decisions are often made at the family level. Individual income controls are inadequate to determine family savings rate behavior, since savings decisions are based upon the entire family's expenses and income flows. Furthermore, 60% of the black sample in the Ariel Hewitt study consists of women in comparison with 48% for whites. Given racial differences in marriage rates, using individual rather than family income masks the potential lower resources to save in the black sample. Urban Institute fellow Kilolo Kijakazi, in her 2010 testimony for the Employee Retirement Income Security Act Advisory Council on Disparities for Women and Minorities in Retirement, cited a more nationally representative study by the Center on Retirement Research, which finds no residual difference in pension savings. Kijakazi observed that for comparably situated individuals, blacks, whites, and Hispanics responded in similar fashions in terms of joining a 401k plan and deciding how much to contribute. In addition to savings out of income or active savings, family wealth also can increase as a result of passive savings. In short, if the value of a family's assets rises/appreciates, then so will their net worth. The Gittleman and Wolf study cited above, based on data collected before the predatory subprime and mortgage market crisis, also finds no significant racial advantage in passive savings for whites families with positive assets, again, after family income is taken into account. This leads to myth 5, the claim that the racial wealth gap is driven by a lack of financial literacy on the part of blacks. Myth 5 includes the assertion that blacks display inferior portfolio management skills. Myth 5. Greater financial literacy will close the racial wealth gap. Hamilton and Darity have argued that, all too often, the framing of the racial wealth gap focuses on poor financial choices and decisions on the part of blacks. Evidence put forth to make the case for black financial illiteracy includes blacks' disproportionate use of alternative financial service products like payday loans, auto title loans, and check cashing institutions. These financial services have fees and interest payments that far exceed more conventional options. Other evidence put forth also includes racial variations in portfolio composition, in which the blacks have a much larger share of their assets in the form of home equity. Here, blacks are characterized as making the suboptimal decision to invest in low return housing assets instead of higher yield financial assets. For many Americans with any significant level of wealth, home equity makes up a predominant amount of their assets. The consumption value of home ownership, including access to schools and other desirable neighborhood amenities, and the tax-preferred status of owning a home, should be considered when examining portfolio shares. Regardless of race, historically, a home is the first major asset purchased by most Americans. The key point is whites generally have more resources to invest at the outset. Not only do they invest more in home ownership, they invest more in financial assets too. Basically, whites have more of every asset simply because they have more resources. Hamilton and Darity have observed that attributing the racial wealth gap to a more diverse asset portfolio for whites is ambiguous at best, given that it is wealth in the first place that is associated with having a more diverse asset portfolio. The problem with assigning differences in cost of finance and asset portfolios to difference in financial acumen is its directional emphasis. Meager economic circumstances, not poor decision-making or deficient knowledge, constrain choices and leave asset-poor borrowers with little to no other option but to use predatory and abusive alternative financial services. A negligible level of economic resources readily explains why blacks, specifically, use more predatory financial institutions. Indeed, Jonathan Morduck and Rachel Snyder's US Financial Diaries project reveals that the use of predatory financial products and alternative financial services are often last resort finance options for economically fragile borrowers after all other options, including borrowing from family and friends, have been exhausted. As we have noted above, wealth begets more wealth. Higher levels of wealth enable greater access to more favorable terms of credit. Wealth provides individuals and families with financial agency and choice. It provides economic security to take risks and shields against the risk of economic loss. Basically, wealth is cumulative. It provides people with the necessary capital to secure finance and purchase an appreciating asset, which in turn will generate more and more wealth. Literally, it takes wealth to make wealth, while blacks largely have been excluded from intergenerational access to capital and finance. It merits noting, again, that the Gittleman and Wolf study cited in the previous section, which used panel data long prior to the 2007 predatory subprime mortgage lending crisis, did not find a significant racial difference in assets appreciation rates for households with positive assets once household income is taken into account. This result emerged despite the well-documented evidence of historical and ongoing housing and lending discrimination. There is also a presumption that, as a result of financial irresponsibility, blacks carry much greater debt than whites. But this presumption is not valid. Tippett and co-authors found that, overall, a slightly larger share of white families has unsecured debt than black families. Furthermore, after controlling for basic socioeconomic and demographic characteristics, the study finds no significant difference in the value of black and white family unsecured debt holdings. When unsecured debt is disaggregated into three categories: 1. store bills and credit card debt. 2, loans from a bank or credit union. And 3, other types of debt, including student loans and medical bills. It is only the other category in which there is a statistically significant racial difference in unsecured debt. 21.5% for black families and 19% for white families. This debt category represents borrowing for school and other critical needs, including medical care. Paul et al. Demonstrate that relatively better off students who are able to attend college, blacks are 25% more likely to accumulate student debt and, on average, borrow 10% more than their white counterparts. The adverse implications of the liability produced by these racial differences in self-investment debt are compounded by the fact that black students are 1/3 less likely to complete their degrees, often because of greater financial burden that precipitated student loan borrowing in the first place. Paul et al. Found that 29% of black students who leave college after their first year do so for financial reasons. Student loan debt and mortgage debt traditionally have provided Americans with access to the finance needed to purchase an appreciating asset such as a house or secure a job in the professional or managerial sector. In effect, mortgage debt and student loan debt may be considered a form of good debt, especially in comparisons to other types of debt like credit card debt, which is often associated with consumption or some good that rapidly depreciates in value. However, the implication of so-called good debt has different meaning once we consider race and the prevailing framework of subjecting a marginalized racial group to inferior housing and educational products, predatory finance, and labor market discrimination. Also relevant is the intensifying context of economic precarity and income volatility in U.S. labor markets, where Americans, and blacks in particular, increasingly have less control of when and for how long they work. This makes access to short-term credit, including credit card debt, an essential element in management of household budgets, particularly for vulnerable households without the financial cushion of liquid assets. Pressure to utilize credit cards to balance household budgets in the midst of expense and income volatility continues despite substantial reported disdain for their use. As stated above, it is ultimately racial differences in initial endowments of and access to financial resources that sustain and fuel the racial wealth gap. According to the Pew Charitable Trusts, white families tend to have greater access to mortgages and credit than black and Latino families. Even when black and Latino homeowners are able to secure mortgages, they experience higher rates of foreclosure and housing distress than white families, in part because they are systematically offered riskier loans. This obviously has implication with regards to myth 2, that the racial home ownership gap is the driver of the racial wealth gap as well. Furthermore, home equity for black American homeowners has not increased at the same rate as it has for white homeowners, largely because home values in the neighborhoods to which blacks have been systematically restricted have been slow to recover since the housing crisis. Consequently, they also have generated lower returns on mortgage debt. Other research suggests that inheritances and other intergenerational wealth transfers often benefit white families more than black families. Greater financial literacy can be valuable if an individual or household has finances to manage. Financial literacy without finance is meaningless. There is no magical way to transform no wealth into great wealth simply by learning more about how to manage one's monetary resources. While wealth begets wealth, typically, no wealth begets no wealth, regardless of how astute a money manager the person may be.